Ever opened your credit card bill and thought, hold on, how did I spend $1,200, but the bank says I owe $1,350? That mystery charge isn't a scam, it's not a mistake, it's credit card interest. And if you don't understand how it works, that small extra amount can snowball into thousands of dollars over the years. Today, I'll break down credit card interest explained with real examples in the USA. By the end, you'll know exactly how banks calculate it, how much it really costs, and most importantly, how to beat the system. Stick around because this one video could literally save you thousands of dollars. Let me share a story. A friend of mine, Mike, got his first card after college. He thought, it's just $40 here, $100 there. No big deal. Fast forward a year, and his balance hit $4,000. He could only afford the minimum payment, about $120 a month. Want to guess how long it would take him to pay off that debt? Over 16 years. And the total he'd pay, including interest, more than $9,000. Mike realized too late that interest wasn't just a fee, it was a trap. And sadly, millions of Americans are in the same cycle. So how does this interest actually work? Let's break it down. Here's the simple version. Credit card interest is the price you pay for borrowing money. In the United States, it's shown as the APR, annual percentage rate. So if your APR is 20%, that means if you borrowed money and carried it for 1 year, you'd pay 20% extra in interest. But here's the catch. Interest isn't added once a year, it's added daily, and that makes all the difference. Let's do some math. Say you owe $1,000 with a 20% APR. Let's do some math. Say you owe $1,000 with a 20% APR. Step 1. Convert the APR into a daily rate. 20% divided by 365 days is about 0.055% per day. Okay, so step 2 is to multiply by your balance. If you take 0.055% and multiply it by $1,000, that's about 55 cents per day. Sounds small, right? But over a month, that's about $16 to $17 in interest. And if you carry the balance for a year, you've paid over $200 in interest, just for borrowing $1,000. But here's where banks get tricky, the way they actually calculate it. Most US banks use something called the average daily balance method. So if you buy gas on Monday, groceries on Wednesday, and pay $100 on Friday, all those amounts shift your daily balance. That's why your bill might look higher than you expected because, well, it's not about one purchase, it's about your balance every single day. Grace period loophole. Here's the good news, most cards give you a grace period. If you pay your full balance by the due date, you pay 0 interest. But if you carry even $1 over into the next month, the grace period disappears. From then on, every new purchase starts earning interest immediately until you pay everything off again. Minimum payment trap. For example, let's say you owe $2,000 at a 25% APR, and well, the minimum payment is $50. If you only ever paid the minimum, it would take you over 15 years to be debt-free. And in that time, you'd pay around $3,800 in interest. That's almost double your original debt. Banks love this because it keeps you paying forever, but for you, it's financial quicksand. Good versus bad interest. Not all interests are equal. A mortgage at 5 to 6% might be manageable because, it's tied to a house that grows in value. But credit card debt? At 15%, 20%, even 30% APR, that's some of the most expensive money you can borrow. That's why experts call it toxic debt. It grows quickly and it usually funds things that don't hold value, like food, clothes, or vacations. Alright, let's talk about how to avoid credit card interest. Here are 3 ways to win the credit card game. First, pay in full every month. You should really treat your card like a debit card. Only spend what you already have. Second, set up autopay. Even if it's just the minimum, autopay prevents late fees and protects your credit score. And hey, try to add extra payments when you can. So here's the thing. Use balance transfer offers wisely. Some US cards actually give you 0% APR for 12 to 18 months. That's a real chance to pay down debt without racking up new interest. But just make sure you clear it before the promo ends. Alright, so let's recap real quick. Interest is shown as APR, but it's actually charged daily. Banks figure this out using your average daily balance. If you pay your balance in full, you get a grace period, which means no interest at all. But, minimum payments are kind of a trap. The best way to beat interest is to pay in full, set up autopay, or even take advantage of those 0% offers. If you found this breakdown helpful, just drop a comment with your biggest credit card question, and share this video to help someone else dodge debt. And hey, subscribe is a way to say thanks. Thanks so much for watching. Credit cards can really be powerful tools if you know the rules. But honestly, they can be dangerous traps if you don't. Go check out the other videos I've shared on screen right now for more money tips and credit card hacks. Trust me, you'll want to watch those before you swipe your card again. I'll see you in the next video.